Thanks for following Knockout Crypto. Appreciate you following the channel. We are on Twitter, Instagram, and YouTube. Want to ask that you guys please like the videos, subscribe to the channel, comment. Though that really just helps us out. But we are building better crypto investors at Knockout Crypto, and we are sharing information to help you become a better crypto investor. So today we're going to go over Crypto Trading 101, a beginner's guide to candlesticks. And this is articles by Sam Alment. And it's a good article. I thought I'd share with you guys because we all need to learn about trading. Crypto Trading 101, a beginner's guide to candlesticks. And then you can do your own research later on as you do your own research in how to trade. That kid you know who is now driving a Lambo because he traded something called Dogecoin, he has more in common with Japanese rice traders from the 1700s than you might think. Besides the ability to brag about their newfound riches, both traders likely analyze price action and investors' emotions by using a candlestick charting style. Although modernized in the late 1800s by journalist Charles Dow, the core principles of the candlestick charting remain intact today. Both the modern and historical technical analysts who swear by the style regard price action as more important than earnings, news, or any of the fundamental principles. In other words, all known information is reflected in the price, which is precisely displayed in the candlestick. The anatomy of a candlestick. A candlestick represents the price activity of an asset during a specific time frame through the use of four main components: the open, the close, the high, and the low. The open of a candlestick represents the price of an asset when the trading period begins, whereas the close represents the price when the period has concluded. The high and the low represents the highest and lowest prices achieved during the same trading session. So as you can see here, the high, the close, the open, the low, upper shadow, real body, lower shadow. Every candlestick uses two physical features to display the four main components. The first feature, known as the body, is the wide midsection of the candlestick, and it depicts the open and close during the observation period. Most charts will allow you to set the range for the candlesticks. The close is represented at the top of the body in the green candlestick and at the bottom of the body in the red. So you see the close here at the top, close here at the bottom in the red. On the opposite is true of the open, which forms at the bottom of the green candlestick and at the top of the red candlestick. The final two components, the high and the low, are represented in the second feature of the candlestick, known as the wick. Wicks are simply displayed as the thin lines extended above and below the body. Wick is this line here high, the wick is this line here low. Cryptocurrency traders tend to take advantage of the inherent market volatility by using charts on the intraday timeframes. Each candlestick typically represents 1, 2, 4, or 12 hours. A long-term trader will likely choose to observe candlesticks that represent a single day, week, or month. A candlestick becomes bullish, typically green, when the current or closing price rises above its opening price. The candlestick becomes bearish, typically red, when its current or closing price falls below the opening price. I just want to read that again. A candlestick becomes bullish, typically green, when the current or closing price rises above its opening price. The candlestick becomes bearish, typically red, when its current or closing price falls below the opening price. The money makers. A candlestick rarely keeps its figure for too long in the volatile cryptocurrency market. For instance, if the 2-hour candlestick opens at a price of $10 and jumps to $13 an hour later, the shape of the candlestick will have drastically changed since opening. But traders have also come to realize that same candlestick shapes occur at the same stage of a price trend, no matter what is being traded. It can be very lucrative to identify such formations because they can expose clues as to when a trend might reverse, continue, or when market indecision is at its peak. 3 of the most useful candlesticks for identifying a potential trend change or for gauging market sentiment are the doji, the hammer, and the shooting star. The doji is a prime example of what traders mean when they say a candlestick represents human emotion or market sentiment. When the asset price swings in both directions before closing near its opening price, it is clear the market is indecisive about the asset's true value. The doji. The classic doji candle represents an indecisive market comprised of equal length wicks and a very thin centrally located body. Further, there are several variations of the doji which signal trend exhaustion or trend reversal. A hammer is the precursor to a potential downturn reversal and can be a big money maker for the bulls. Hammers are formed when the price sinks below the open only to later return and then close above the open. Such price action signifies that at one point during the trading period, sellers temporarily gained control but quickly gave it back, and then for some, a bullish close to the candlestick. The hammer. The physical features of a hammer consist of one wick roughly 2 times the length of the body, which is located at the top of the candle. There. Last but not least, the shooting star is the exact opposite of the hammer. The shooting star occurs at the peak of an uptrend when the bulls rally to start the trading period, but eventually lose control to the bears who drag prices to a close below the open. It is important to keep in mind that the longer the duration of the candlestick, the more powerful its effect on the overarching trend. For instance, a hammer spotted in a one-hour candlestick will most likely have no impact on a 6-month-long downtrend, whereas if the hammer formed in a 1-week-long candlestick, its reversal impact will be much more significant. So I want to just say to you guys in my group, let's go back and study, the doji, the hammer, the shooting star. Let's study what some of these trading things, trading signs mean, and get on our, while we're in this bear market, it's a great time to really get your trading skills up and learn how to trade and learn how to be a better trader. So I definitely want to say to you guys, learn how to chart, learn how to figure out what the candlesticks mean, and become a better trader while we're in this bear market. That's the only way to learn and how to be a better trader is, learning in the bear market how to be a better trader. So guys, thank you for following Knockout Crypto. Let me know what you think about the channel. You can find us on Twitter, Instagram, and YouTube. I'm going to have more good videos for you coming out soon, but thank you for following and supporting the channel. You can really support by liking the video, subscribe to the channel, and comment on the video. I really appreciate that support. Thank you guys. KnockoutCrypto.com, Knockout Crypto on Twitter, Instagram, and YouTube. Knockout Crypto.